my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin. LME 3-month nickel. 11 weeks ago I lodged the idea of there being a large bump and run reversal pattern stretching from July last year until May this year in both your own and my mind. This was a transformation from an earlier descending scallop pattern formed over the same period. I asked you to bear this in mind just in case for future use, as it was a pretty large pattern. However, this large pattern has since morphed again back into a descending scallop pattern, especially in recent days. Looking close at more recent action, we had originally an early February to late March bullish Andrews pitchfork that showed the bullish angle attack of this market until the middle of May, when the market breached the upper time. The breach was repaired, but in doing so, prices swung around 180 degrees and headed lower, pushing down through the lower time 10 weeks ago, carrying on down within a steep bear channel until the start of July, when prices hit the June 2021 low at 17,095. I said 8 weeks ago, and I quote, "This bear channel will dictate the market for the immediate future until it is broken or until the bear channel morphs into something else." End of quote. 6 weeks ago, the morphs into something else happened, with the market sidling sideways out of the bear channel and in the process forming a potential bearish halfway hesitation that last week became a reality. Now, if you look at the formation of the V-top with a pipe top at its apex, formed over May and the subsequent moves lower, you can see the whole V-top action from even February to date was not just a simple V-top, but a V-top with an extension. In these types of V-tops, after the peak, the market starts moving lower, but then forms a hesitation or congestion of sorts, usually a pennant or a bear flag type pattern on the way lower. This hesitation happened here over late June until early to middle July, and could be regarded, as I said 7 weeks ago, and I quote, "a hiccup in the road lower." And with this in mind, another factor to consider is that if we do see prices move down into the 17,100 to 15,845 zone, then the big pattern idea, the one of the descending scallop pattern morphing into a bump and run pattern with some large upside potentials, well, that pattern will be morphing further back into a descending scallop with the significant bearish potentials. Watch this space. That's the end of the quote. This is where we were 2 weeks ago, moving lower, corralled, unlike other metal markets, not by a bearish Andrews or a bearish shift pitchfork, but by a simple dark blue late May to late July downtrend, which you can see highlighted on my daily chart. This was until 2 weeks ago, when very significant lows of late November 2023 plus January and February this year in the 15,840 zone saw tests, and they cracked the downtrend. In many ways, this was not a surprise, not at all. This left the May to date big move lower, the potential bearish halfway hesitation. Well, it left it hanging out there down in the 13,750 zone. It is at this point I feel obliged to mention once again the big descending scallop pattern, what it may mean within the near-term universe. So the key level, as already mentioned, are the lows at 15,840. A significant move below this, and by that I mean you would know it when you see it, a significant break below that level would give a potential for the descending scallop pattern on the downside down in the 13,830 zone, which is not too far from the potential below for the bearish halfway hesitation. Thus, it all comes down to what the market does now that it's reached the 15,840 zone and bounced upwards. Will this move up be sustained, or is it yet another hesitation on the road lower? We'll hopefully know the answer soon. In the meantime, I've drawn a July-based bearish shift pitchfork on my daily chart. A small one, I grant you, in the hope of possibly seeing a newer, shallower bearish angle of attack. I'm not in love with this pitchfork, and I would retire it in a heartbeat if appropriate. At the moment, the market is playing with the upper time, currently at 16,410. LME 3-month zinc. The mid-April to end of May ascending wedge pattern drove this market higher up as far as the neckline of the September to December 2022 reverse head and shoulders pattern, where it peaked with a horn top in late May. This actually turned out to be a false break higher, as prices moved back down, rejected by the neckline. The market subsequently reached the primary and secondary targets for the horn top, but the decline became hesitant in mid-June, especially when it reached down to the interesting support, currently at 28.08, of the broken upper tine, highlighted in dark blue, of the old May to August 2023 bullish shift pitchfork that had acted back then as an August 2023 to April 2024 upper bull channel line. I said 9 weeks ago, and I quote, "This is the first decent support we have seen, though I would not be surprised if prices do not move further down near the middle time, currently at 26.43, end of quote. My initial reasoning for this was an early June based bear channel, and I said at the time, and I quote, "This bear channel is running the market at this moment until it breaks or morphs into another pattern. It will continue to do so," end of quote. Well, 9 weeks ago, prices broke out of this bear channel, or rather prices wandered out of the bear channel and stood around just like cattle that had broken out of a field and now looked dumbfounded. In the end, prices rose in late June, peaking in early July, just over the big old 50% Fibonacci line for the 2008-2022 move at 29.65. I said 8 weeks ago about this move higher that, and I quote, "But we can look as also a possible form of a halfway hesitation in a potentially much larger move lower. We'll have to see how this develops, and I'm sure it will have caused the move, or at least cause another change, another morphing into another pattern by then," end of quote. Since then, the market has undergone a number of changes, turning lower and indeed becoming a bearish halfway hesitation pattern, though it is such an ugly looking pattern. Yet it did have potential down in the 26.30 zone, which was reached 2 weeks ago. However, all this had given me the opportunity to draw a new late May to early July bearish shift pitchfork, highlighted in bright red on my daily chart. For the moment, this is the pattern showing the driving bearish angle attack of the market, though I have to admit this is quite a wide pattern. Right now, prices are just underneath the middle tine, or on it actually, and that's currently at 26.93. One of the most interesting features of the move lower, apart from utilizing the tines of the old dark blue May to August 2023 bullish shift pitchfork, has been the test and pull back up over the gold highlighted long moving average, currently at 26.64, when testing the dark blue middle tine and the March 2021 low at 26.27. Prices dipped down as far as the February 2021 low at 25.47 before returning back upwards. This dip has been interesting, as the support at 26.01, which was pierced, is the gateway to all the congestion we saw last year that stretches down to at least 23.97 level. Finally, to top all of this off, we had a monthly key reversal down here in July, and the shadow of this hovers over all of these patterns. LME 3-month tin. Over April and May, we saw the market form a double top Adam and Eve type. However, this pattern, despite this pattern, the market was not finished with its creation of patterns, with prices attempting to drop down through the 50% Fibonacci line of the March 2020 to March 22 move at 31.845, as well as the neckline. However, all these supports together caused a reversion back up. But by the middle of the second week of July, this reversion had also failed. Prices dropped down again, back to where we had previously been. This failure to try for targets below for the small narrow head and shoulders top back in April, and then the double top pattern, Adam and Eve type, eventually led to another pattern, April to July triple top. It also clarified the April to July sideways triangle highlighted in purple on my daily chart, which had first a false break on the top side, but then a proper break below, late 4 weeks ago. I said as much 7 weeks ago, and I quote, "As a result of all this, a new larger pattern emerged last week," so that's now 7 weeks ago, "a late April to date sideways triangle highlighted in purple on my daily chart. This pattern is much like the double top, still not complete, having only 2 touches per side, but it has potential, so I could see it working together with the double top idea, or maybe not working with it and making something else. Either way, keep a close eye on the purple lower trend line, currently at 32.625. as it could also be seen as a neckline for the whole double top idea," end of quote. The market followed up on some of these ideas for the purple sideways triangle. We had a primary target in the 29.70 zone, a target already achieved, and a secondary harder to reach target way down in the 26 to 60 zone. Meanwhile, the triple top had a primary target down in the 30-100 zone, a target already achieved, and a secondary harder to achieve target X1 down in the 28,070 zone. A target has been nearly achieved. On the way lower, we had congestion between 28,835 to 29,005, containing the July 2011 high at 29,005, plus just below the slowly rising gold highlighted long moving average, currently 28,725, and a neckline extension of the October 2023 to January 2024 reverse head and shoulders bottom, currently at 27,725. And finally, the 50% Fibonacci line of the March 23 to April 2024 move at 27,330. The best of these have been the gold long moving average and the congestion between 28,305 to 29,005, as they halted the market's decline, making higher lows both 2 weeks ago and again last week. I suppose you could also throw in the middle time, currently at 28,130, of the April to July bearish Andrews picture I drew 2 weeks ago as well, but I'm personally stick to the gold long moving average and the congestion zone. Since that push back up in late July, almost looking like a double bottom, prices have risen but gotten stuck in what I can best describe as an accidental congestion area overhead, created by the mauve medium moving average, currently 31,840, the short medium moving average, currently at 31,915, the 50% Fibonacci line of the March 2020 to March 22 move at 31,845, and the neckline of the thin and tall April base head and shoulders pattern. Yes, that one. The one I mentioned a lot back then. Well, that's currently at 31,715. This accidental area is actually the gateway to a whole load of congestion overhead dating from April until mid-July, and I'm having doubts about whether the market has the ammunition or the inclination to take these things on. For the moment, I would still suggest watching the new bearish Andrews pitchfork to be the main guide in this market. My final point relates to this summer. We had a monthly key reversal down in July. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.